Did you know most people are completely oblivious to what central banks are trying to do with inflation? What is more shocking, research shows that increased inflation can incentivize consumer spending. You might be totally in the dark about the real numbers. Households estimated annual Eurozone inflation at nearly 9% when the actual rate was a mere 1.6%. Learn how raising interest rates actually works and get in control of your finances. So, what happens when things get too expensive? That's inflation, and it means your money doesn't buy as much as it used to. To keep prices steady, we have central banks like the Federal Reserve in the US. These banks have a big job to manage the economy and keep inflation at a good level, often around 2%. One of their main tools is interest rates. Think of interest rates as the cost of borrowing money. When you take out a loan for a car or use a credit card, you pay interest on top of what you borrow. The central bank sets a key interest rate that affects all other interest rates in the economy. When the central bank raises interest rates, it becomes more expensive for people and businesses to borrow money. This is how it works. Imagine a small business owner considering expanding their shop. If interest rates are low, they might take out a loan to build a new store. But if interest rates rise, that loan becomes more expensive and they might decide to hold off on the expansion. The increase in the interest rates decreases aggregate demand. It helps get closer to potential output and stabilizes prices. The same thing happens with consumers. When interest rates on credit cards and mortgages go up, people tend to borrow less and spend less. For example, a family might postpone buying a new house or car if the interest rates are too high. This drop in spending across the board lowers the overall demand for goods and services in the economy. Now, when demand goes down, businesses can't raise prices as easily. If people aren't buying as much, stores have to keep prices competitive to attract customers. This puts a check on inflation. It's a demand pull situation where aggregate demand gets influenced, which is determined by various economic factors. But there's another important piece to the puzzle: inflation expectations. If people expect prices to keep rising, they might start demanding higher wages, and businesses might start raising prices in anticipation. This can create a cycle where inflation becomes self-fulfilling. Inflation expectations help manage future inflation outcomes. Also, if expectations are anchored to the bank's inflation target, the higher inflation may not affect household and firm behavior. Central banks try to manage these expectations by clearly communicating their goals and actions. If people trust that the central bank is committed to keeping inflation low, they're less likely to demand higher wages or raise prices, which helps keep inflation under control. There are also two main types of inflation: demand pull and cost push. Demand pull inflation happens when there's too much money chasing too few goods, as we've been discussing. Cost push inflation, on the other hand, happens when the costs of production rise, like if the price of oil goes up. Raising interest rates is more effective at controlling demand pull inflation than cost push inflation. Supply chain disruptions and commodity prices are also reasons for commodity price increases. It's also important to consider how higher interest rates affect savings and investment. When interest rates rise, savings accounts and bonds offer higher returns. This encourages people to save more and spend less, further reducing demand and inflation. As savings levels increase, then volatility should decrease, encouraging stability. Plus, when a country raises its interest rates, it can make its currency more attractive to foreign investors. This can lead to a stronger exchange rate, which makes imports cheaper and exports more expensive. Cheaper imports can also help to lower inflation. However, raising interest rates isn't a perfect solution. It can also slow down economic growth and even lead to a recession. If businesses and consumers cut back on spending too much, it can hurt the overall economy. That's why central banks have to carefully balance the need to control inflation with the need to keep the economy growing. They look at a variety of factors like employment numbers, economic activity, and financial market conditions to make the best decisions. It's worth noting that there are other things that can be done to stabilize the economy, such as the government enacting fiscal policies like government spending and taxes to influence the aggregate economy. A combination of government action and central bank action is often considered best to give the best opportunity for financial stability. While this video helps explain the mechanics of how raising interest rates controls inflation, there are still a lot of unanswered questions. As the causes for inflation remain disputed amongst even economists, and that inflation expectations have been historically overlooked in monetary policy decisions. One can see why this is such a tricky topic. Also, it is worth to note that policy changes of the central bank often require time to be effective, therefore, it is difficult to pinpoint the exact effectiveness of the changes. If you found this video helpful, please like, share, and subscribe to our channel for more videos on finance and economics. Also hit the bell icon for notification. And if there's anything else that remains unanswered in the video, comment below, and maybe we will make another video on the same topic.